Each investment account in Canada has a purpose with minor details that most people tend to overlook. And these end up costing them big money in the long run. And so in this video, I'd like to go over some of these details and mistakes that most Canadian residents make so that you can take full benefit of these, save money, as well as make some in the process. Let's get into it. Investing in US-based dividend stocks using your TFSA. The most popular US investment is the S&P 500 fund or the ETF, where you invest in the top 500 companies in the US stock market. But did you know that it offers a dividend of 1.65%? And this is exactly the case with a lot of other stocks too. But did you also know that there's a tax withholding of 15% of these US dividends in your TFSA? So although you're investing in a tax-free savings account, the dividends are taxed at 15%. So what's the solution here? Well, if you don't really care for the tax you're paying, then that's fine. You can assume that that's the cost of investing in such stocks. Or you could do what I do, which is I invest in these ETFs and stocks using my RRSP instead, because there's no tax for these dividends within an RRSP. This is because the RRSP is recognized by the US as an official tax registered account, while the TFSA isn't. And since there are dividends issued by a good chunk of my portfolio, I save quite a bit on these taxes. Not opening up an FHSA, a first home savings account. Unlike the TFSA and RRSP, whose contribution limits are automatically allocated either based on when you moved to Canada or based on your previous year's income, the FHSA operates slightly differently. It is true that the annual contribution limit for an FHSA is $8,000 with a max of $40,000 for the account, which accumulates over 5 years. That is $8,000 per year. But this total balance is not automatically allocated to you every year like in the case of a TFSA. Instead, it only starts accruing from the day you open your FHSA account. If you miss out on opening an FHSA a particular year, then you lose out on that year's $8,000, which in turn means you'll have to wait an additional year to get to the max $40,000 mark. So even if you don't have any plans of investing in an FHSA this year, it would be wise to simply open an FHSA on any of the trading platforms of your choice. It doesn't cost you anything, and instead it could potentially open up investing opportunities for your future self. Not opting for an employer match through your RSP or RRSP. If you're employed here in Canada, then you need to find out if your employer provides a match to your RSP or RRSP contribution or not. A lot of people take this for granted and just go with the default offering that the employer provides, which could potentially mean no contribution from the company's end, or you're leaving money on the table. Basically, the concept here is that you can choose a portion of your salary to be deposited into your RRSP account, and your employer would match that amount or a portion of that amount, which basically means free money. And not to mention that this amount that you contribute voluntarily is also tax deductible, which means you can deduct this against your income, which in turn means you could fall in a smaller tax bracket. I have personally seen my own colleagues get overwhelmed with all the benefits and numbers that the employer throws their way. But spending some time trying to understand the details can go a long way. I would also suggest reaching out to someone who has been in the company long enough or the HR teams to understand more if you're unable to do this on your own. Talking about RRSP contribution, RRSP room, first year as an immigrant. Immigrants who move to Canada and start working from the offset tend to assume that the limit that they have for the first year is 18% of their salary, which is normally the case for an RRSP. But that's not really the case for the first year immigrant. The first year you're here, you would have $0 as a limit because the RRSP limit is basically 18% of your last year's income while you were in Canada. And since this is only your first year here in Canada, you'd have a whopping $0 as your contribution limit. And this means that you shouldn't be technically using your RRSP in the first year. And if you contribute over your limit, then you have the flexibility of $2,000 that you can contribute up until you're not charged anything. But anything above that, and you charge 1% for your contributions every month of that year from that point on. So if you're keen on making investments, then my suggestion is to focus on the TFSA and FHSA in the first year and then move on to your RRSP in the second year. But if you're getting a significant amount from your employer as part of the employer match and the 1% deduction you feel is a small price to pay, then consider that as the cost of investing in the RRSP in the first year. Not understanding how any of these investment accounts work. This is a very important point that a lot of people get wrong. People assume that simply transferring or contributing to an RRSP, FHSA or TFSA means that they're investing and putting their money to work. Although all these accounts have the word savings in them, the tax-free savings account, the retirement savings plan, the first home savings account, these are not really savings accounts at all. And they've gotten the name all wrong. Instead, they're actually investment accounts or wallets. So this is simply another account where your money simply sits until you do something with this money. It's your job to pick out the right stocks, ETFs, funds, investments using this money, where these investments now grow or depreciate within these accounts. I've touched on this topic in one of my previous videos in detail, but long story short, your investment account is like a digital wallet to hold the amount you'd like to invest, as well as a basket of all the investments you bought using that money in that wallet. So don't make the mistake of simply transferring money into these accounts and leaving them to depreciate with inflation. Using TFSA to buy growth stocks. Here, I'm talking about exclusively growth stocks that don't offer any dividends. The big benefit of a TFSA is that you're using after-tax dollars to fund the account, and that there are no taxes on the capital gains when you sell, on the dividends paid out, as well as on any withdrawals from the TFSA too. So if you were to invest solely in growth stocks, then you'd have to wait till these stocks appreciate in value and sell these stocks for you to save on these taxes. For example, if you invest $1,000 in, say, a stock like 𝗔𝗰𝗃, which does not pay any dividends and is solely a growth stock, and you decide to sell these stocks at $2,000. If it takes you 4 years to get to that $2,000 mark, then it's only then that you can truly utilize the benefit of the tax exemption within a TFSA. But instead, if you have identified stocks or ETFs in Canada that pay out regular dividends, then using the TFSA for just that is the best way to go. This is because you could be paid out dividends every month or quarter, and each dollar from that would incur zero taxes. And so in the same example, if you were to invest in, say, Scotiabank, which pays out a whopping dividend of more than 6% every quarter, then every dollar you earn from that will be tax-free. This is the smartest way to use a TFSA in my opinion. But having said that, if you don't want to invest in any dividend-based stocks, then by all means invest in the growth stocks and still utilize the tax exemption on the long-term capital gains. Saving your emergency fund within your TFSA. Emergency fund here refers to your safety net or amount that you've saved for unforeseen circumstances. In my case, I have about 6 to 7 months of all recurring living expenses saved and stored away in my high interest savings account. I've heard numerous people online and in person say that they have their emergency funds stored or invested in the TFSA, which in my opinion is a really bad financial decision. Well, for starters, you never know when some emergencies might pop up, and you would need this liquidity to bail you out. And the last thing you want to do is have to either liquidate your investments in your TFSA and wait for it to be available in your bank account. Not to mention that if the money you had invested has depreciated, then you're just losing out big time. And if you plan to simply keep the money in the TFSA and not invest it, then it just goes back to a previous point I mentioned. Not doing anything with the money means that the money is losing its value over time. So the best approach is to keep it in a high interest savings account where you accrue a decent amount of interest to at least try and keep up or beat inflation, and to only transfer money into a TFSA that is for investment purposes only. So yeah, don't get greedy and risk this safety net for anything. I had a whole lot of other points that I'd shortlisted for this video, and I'll release a part 2 of this topic if this video gets enough likes and comments. So if you found this video useful, hit the like button and leave me a comment down below. Since you're now aware of the mistakes to avoid with these accounts, how about checking out this video where I talk about the best order to invest your hard-earned money so that you can make more money in the process. Thanks for watching, and I'll see you, well, probably here.